Thank you for joining me on today's episode of the Simply Financial podcast. I'm your host, Christopher Calandra, and I have my friend and partner, teammate, Brett T. Pasquale, who is a routine on the show these days. And we are going to talk today, because we want to increase your financial IQ, a little about behavioral investing. Is that a good way to put it, Brett?
Yeah, I think that's a good way to put it. Behavioral investing, expectational investing, kind of what to expect when you're an investor in such a volatile market like we are now.
So, regular listeners of the show and clients that we have met with over these many years will not be surprised that this is an element of the work we do internally here at Elliott Wealth Management, as well as in discussions with clients, because we often talk about being unemotional about our investment decisions, which sometimes is difficult to do, including in a politically charged environment. So that's another way to say it, right? Behavioral also has a lot of elements of uh, emotion built into it. No?
Yeah, I think a good way to put it would be that humans in their nature are unrational. And when it comes to investing, you need to have an element of rationalness to you, but that's not the gut reaction most investors feel, especially at pain points in the market.
Very good. And what we have done is recently, with your leadership, created sort of a document or a one-page executive summary that directly talks about this behavioral aspect and what our clients need to consider, as well as how they can feel confident. Can you talk about some of the major elements of what we have put together based on our experience and research?
Yeah, I think it's a timely document just to kind of set expectations for our clients and also just broad expectations as an investor in general, especially going through a market like we have this year. I mean, we started at all-time highs. We had a pullback in April, May timeframe, and now we're at even higher all-time highs. So I think the biggest goal of the document is really setting and managing expectations and feelings while investors are participating in this market. So I'll just outline a couple things inside of it. Just current, like basic principles that we should all keep in mind as an investor. So the first thing is that markets in the economy are obviously unpredictable. We watch TV, we watch headlines, we watch the news, and all these headlines pop up of all the experts forecasting what could happen, what may happen, positive, negative. And we have to remember that they always are going to sound confident when they're on TV or on the radio, but they're often unreliable and often also incorrect. So that's just something to be aware of. Second thing is market sell-offs in general cause others to sell. Like I mentioned before, human beings are irrational. We always live by the mantra of buy low, sell high, but investors like to do exactly the opposite of that. They like to sell high, or I'm sorry, sell low and buy
Yeah,
high because
yeah.
because of purely emotion. And that's exactly the opposite of what you're supposed to do.
Yeah, there's an element of that, the herd mentality. And if the herd is going one way, there's a great impulse to follow the herd. The difficulty with that in investing is the herd can often be wrong, and following the herd may not be helpful.
Right, and it's totally normal to feel that way. When the market goes down, your fear reaction kicks in and you want out. It's not a pleasant experience. It's not comfortable. But sticking to the principles of investing, those are really opportunities and are built into your overall risk score and overall plan. So that's important.
So you talk about the plan. So we're financial planners, so we like to plan for our clients. And I'm a geek, I plan everything in my own life. So that's a key part of this, right? Because one of the ways to protect yourself from some of these uh, potential bad outcome behavioral uh, aspects is to have a plan and then stick with the plan probably will serve you well. Could you talk a little bit about that?
Yes, I mean, sticking with the plan is the most important thing to do, but it's also in our profession kind of the worst thing you can say to a client. So if the market's down, that fear kicks in, the uncertainty kicks in, and just saying stick to the plan really doesn't solve anything emotionally for the client. So that's the worst thing that we could say.
Yeah, I gotcha. It's like when
Yeah.
somebody says, don't panic.
Right, right. But I mean, clients and investors have to realize that fear is a natural part of the entire investor experience. Markets go up and markets go down, but it's important that when we make decisions in our portfolio and clients' accounts, we're making those decisions based off of risk tolerance, based off of statistics. We're not being emotional about them. Now, do we try to catch trends sometimes? Yes, but those are based off of what we see coming down in the market rather than emotional reactions.
Very good. Uh,
And
so,
yeah, go ahead.
yeah, no, you go.
No, I was just going to say another thing is that when markets do pull back, and I'll just reference back in April and May during all the tariffs, all the tariff implementation. I mean, we get calls from clients. They want to abandon the plan. They're really looking not to abandon their plan. They're looking to feel better. That's the only thing that it is. It's not looking at the long-term success rate. It's looking to feel better in that moment. And that we have to acknowledge that that's completely normal. But it's our job as financial planners to keep you informed and also try to keep you as comfortable as possible by setting expectations. That is the biggest thing, setting expectations.
I know this isn't really the topic of today's discussion, but I think this is noteworthy because over the course of my 30 plus year career, and I know you've had a long career, though you're much younger, is one of the key roles we play with clients is to help be a sounding board and to talk things through, especially when things are not going well, to help our clients make good decisions. And you have this huge school of thought out there, do it yourself investing, where you don't need a financial advisor because you could just do it yourself. And that is true. But but that does leave the investor open to going it alone and maybe getting caught up in the herd in a negative way far too often because one of the central roles for you and I and the rest of the team here at Elliott Wealth Management is to communicate with our clients when things are not going well, to provide facts and unbiased information, historical perspectives, to be calm, reasoned, and professional to help them maybe from their worst urges and sometimes just talking through things or reading a white paper or an email talking about what's going on will dampen people's concerns and get them to make better decisions than they might have made if they were just dealing on their own. We act as great partners in that capacity. You agree with that, right?
Yeah, absolutely. I think we play not the role we play the role of financial planner, investment manager, but also psychologist. I mean, our
Yeah.
job is to manage emotions as well. And that's one of the most important and could be one of the most detrimental things inside of investing.
Yeah, and you think back to the episode you and I had done going back to the lead up to the presidential election between Kamala Harris and Donald Trump. And we talked about there's no need to panic, regardless of who wins. Um, history tells us, our research tells us that there's no reason to abandon first principles and our plans, regardless of who gets elected president, and actually made the case that oftentimes when a president gets elected, the market often can experience a good stretch. And that was good content. That was good information for everyone. And it was proven to be accurate information because at least in the last election, that advice was profitable advice. So as we wrap up, Brad, anything else about behavioral finance you want to share with everyone?
Yeah, I think there's one important thing to bring up. I mean, we've talked a lot about how to handle down markets, but currently we're in a really good bull market. The market's at almost an all-time high. It's hit some all-time highs. So all of this not only applies to down markets, but it applies to up markets and also managing greed in a way.
Yeah, that's a good point.
Be- Yeah, because I mean, with markets at an all-time high, sometimes we get the question of, well, the S&P 500 is doing X and my portfolio is doing Y. It's lagging the S&P 500. And just things to keep in mind is as we manage risk, that's all part of the plan. So just keeping expectations dialed in to what your specific goal is going to help in both really good bull markets and also in uncomfortable bear markets.
That's right. Not to get too caught up in the herd and a frenzy in a good market and get too greedy where you become more risky than you would normally do. And you might get more than you bargained for if you have a bad period that often follows these strong periods. So I get that. You have a conservative investor who has a good plan, and then because the market has a really good run, they might want to get more risky than they probably should be. And that's another way that we could work in partnership with people to keep them where they should be by talking it through and being clear-eyed about what's going on. So I love that. Everyone, thanks for listening to today's episode. Brett, thanks for sharing this with all of us.
Thanks for
I
having me.
I will be back. We will be back on the next episode of the Simply Financial podcast very soon. In the meanwhile, if you haven't done so already, please subscribe to the podcast, share it with a friend. We would really appreciate that. Thanks again. We'll be back with you soon.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.